Yeah. Okay, so according to Gary Keller, every realtor should strive to be the economist of choice because our clients are going to look for us for advice. That's our job, to advise them, right? And the only way we can advise them is to understand what's going on. And hopefully in this class, we will have talked about some things that you might want to pay attention to, and so that you can better understand the markets and what might be coming in the future. The best predictor of future behavior is past behavior. Something like that. The best predictor of the future is past behavior. So if we can look at the past and see how different things affected the performance of a market, then we can predict what's going to happen in the future. You're going to be asked, is this a good time to buy? Should I wait? Is it a good time to sell? Should I wait until next spring or in the winter or whatever? What I want you to be able to do by the time we're done with this is to be able to look at what's happened in the past and to reliably give good information to your clients. Tell you what to pay attention to, which is key economic. Go ahead. Yeah, awesome. I could certainly do that. Yeah, I can send. Look at that. You're awesome, Colleen. Thank you.
Right. To the left, go back.
Thank you. Superstar. So we want to be able to identify the key economic indicators that you want to pay attention to so that you can talk about what's happening in the market, so that you can understand what's happening in the market, so that you can make informed decisions for yourself, and so that you can advise your clients to make the best decisions. You want to be able to have these conversations and speak with confidence, right? Somebody says to you, hey, is this the time to sell my house? Yeah, well, that's basically the answer, and we'll talk about that, right? But, oh, this is great. So there's some basic concepts that I want to talk about before we get too deep into anything. And the big one is supply and demand. Supply and demand drives every flipping market. I don't care if it's oranges or housing. Share price of computers, anything is driven by supply and demand. And the basic concept is, although it drives every market, some people struggle with the basic concept. But let's talk about housing and how we monitor supply and how we look at demand. So with supply, we look at inventory, right? The number of houses that are available for sale at any given time. Say we have 950 homes for sale today in the market. 3 years ago, we had 2,500. Obviously, the inventory is down. How does that affect sales price? How does that affect demand, right? So some general principles apply to every market. If I was selling tomatoes and I'm a farmer and I bring them to the market and it's summertime and I've got an abundance of tomatoes, I'm not going to be able to charge a premium. I'm not going to be able to sell those tomatoes for $5 a piece because nobody's going to pay it. They'll go to ShopRite and they'll get a dozen tomatoes for $5 or whatever, right? However, if we went through a drought and I have a basket of tomatoes and ShopRite doesn't have them, maybe I could charge more. Maybe I could get $5 for a tomato. So it's the supply, who wants those things, how much demand there is. Maybe at $5, nobody's going to buy a tomato. But me as the farmer, if I don't sell them, they're going to rot. I'm not going to make any money. So there's the price that factors into it. But It's all driven by how much supply we have and who wants them. In the housing market, if we have an inventory of a certain number of homes, we have to also look at what the demand is. How many buyers are out there? So we look at demand by how many closed homes there are on any given month. Is that more this month than it was last month? Is it more, say like if we looked at July's numbers, is July more than it was July of this time last year? So is demand down this July relative to last? Why would that be important? Well, in most markets, things change seasonally. So there might be more sales in the summer than there are in the winter. So we wouldn't necessarily want to compare closed homes in July to closed homes in February. If we sold 205 homes in July and we only sold 165 in February, well, it looks like home sales are up, but seasonally, it's usually down in the winter months. So we want to be able to look at those numbers and have them make sense. I want you to understand where you can find those numbers and how to interpret them. And that's kind of what we're talking about. Other things that are going to impact the overall market is obviously affordability. So interest rates, sales price, unemployment, who's working? Are a lot of people out of work? Wages and compensation. Are wages keeping up with inflation? This all impacts affordability. So interest rates, whether they're going up, whether they're going down, how can we kind of get a feel for what's happening? The Federal Reserve regularly comes out and gives us their forecast on what they think there is going to happen. And they know better than anyone because they're the ones pulling the trigger. So in the handout, I put down some links to places where you can reliably find this information. And as I go through it, I'll talk about where you can find it. Marty.
Just a comment. There's also an economic concept. How many new homes are being built?
Yep.
And also how many new households?
Correct. So we'll also look at housing starts. But so let's get some basic things. It's just real quickly. Who can give me an example of financial irresponsibility? Whether it's personal or too much debt.
Yeah.
Okay. Anything else? Bad credit. How do you get bad credit? Too much debt. Okay, and what else? Delinquent. Okay. Yeah, too much debt. Okay, so I see a theme here. You take on too much debt, you're being irresponsible. No reserves, no savings. Handwriting's not my specialty. Anything else that you would say is being irresponsible with your finances? Excessive debt.
Yeah.
Or too much debt. All right, so we got a theme going here, don't we? That was a good one, Gentile. So when you do these things, what happens? What impact does it have on you personally if you're financially irresponsible? So here's what I put down. I said that spending beyond one's means, excessive debt, a lack of financial, these are all like, you could all say them by saying too much debt, basically. Disregard for your financial long-term health, inadequate planning for your obligations, which is what you were talking about, and unsustainable levels of borrowing. So I don't care if you're an individual or a government, if you're doing those things, you're being financially irresponsible. The consequences of this irresponsibility are higher interest rates, not only for you as an individual, but also for a nation, right? If your government is financially irresponsible, they take on too much debt. The way that they then combat that is by raising interest rates to shrink the monetary supply and so forth. Not only higher interest rates, but why are they doing it? They're doing it because they need to take care, pay a bill. Maybe we go to the grocery store or the clothes store and we buy that pair of shoes or this whatever, and we really can't afford it, but we charge it, and then you have this debt for that pair of shoes that you couldn't live without, right? It's that short-term gratification, but you're gonna have long-term pain, because that $100 shoes that you felt that you needed, I don't know what I just did there. Yeah, I did, thanks. But I didn't know what I hit. It just went to a totally different screen. For a nation, you know, that's gonna, that increased borrowing is gonna be, it's gonna show up in the way of inflation because they're printing money, and by the money printing, the more money you have in circulation, the more money chasing the same number of goods and services is going to drive up prices of everything. It also reduces economic growth. It's a cycle that's created. The long-term debt. So back to, you know, the basic principles that we want to talk about: supply and demand. And here's what I'd like you to focus on: is if demand exceeds supply, then prices will rise, right? So if we had 100 houses on the market today, and we had 200 people that were out shopping for that type of house here in this market, you have 200 buyers, 100 homes. They're all going to be, those 200 buyers are going to be competing for those 100 homes, and they're going to bid, and those prices will get bid up. Conversely, if there was 1,000 homes on the market and only 200 buyers, maybe the buyers could be a little bit more selective. They have 5 homes to choose from now, right? They don't need to compete. So that's the basic concept of supply and demand. By having a lot of supply, prices will tend to drop down. So in a seller's market, we talk about a seller's market, buyer's market, or a balanced market. In a seller's market, sellers have more control as you go through negotiations, because if this deal doesn't work out, put the home back on the market and we'll get it sold, and we'll deal with the next person. So they have that general mentality, or tend to have that mentality. In a buyer's market, buyers might be more selective. They might be a little more apt to ask for things that might be considered unrealistic in a seller's market. A balanced market would be neither a seller nor a buyer has a lot of control over negotiations or leverage in a negotiation, but you know, both are equally as eager to try and to get through a deal. And we measure that by months of supply, right? And we'll talk about how we look at that. But as a general rule of thumb, if you have 6 months worth of inventory, it's a balanced market. And if you're below that, we're in a seller's market. Above that, we're in a buyer's market. Now, 6 months, there's also a window. It might be, we're pretty much in a, I feel like we're more in a balanced market now. Sellers still have a little bit more leverage. And we're at about 4.5 months inventory. It's certainly more of a balanced market today than it was 5 years ago, when we came out of the pandemic and it was like the gold rush, right? Would you agree with that, Jim? So we'll eventually get to the point where I'll show you how to monitor these things, where to get reliable information. But I just wanted to go through the concepts. But when you're talking to your clients, whether it's a seller that's asking you if it's a good time to sell your home, if it's a good time to sell their home, yeah, it's a great time to sell your home, right? But why? Why? Should I rent or should I buy, right? If I'm a buyer. Well, I'm thinking about buying, but prices seem a little bit high. Interest rates seem a little bit high. I think I'll wait for them to come down, right? How are you going to talk about that? Well, let's talk about the cost of renting. So I'm going to read through this, but I'll also send these slides out afterwards if you want to go back and review any of these things. But nationally, rents usually increase at a rate of like 3 to 5% a year. In 2023, rents went up 8% on average nationally. If rents were to increase at that rate for 7 years, every year for 7 years, in 7, 8 years, your rent would double. However, if you buy your home today, your mortgage isn't going to go up. Homeowners insurance might go up a little bit. That'll add to your mortgage, certainly. Your insurance costs might go up. But your principal and interest payment, as long as you got a fixed interest mortgage, your mortgage payment is not going to go up. So, and it's not only going to be the same today, next year, it'll be the same in 20 years, and it'll be the same in 30 years by the time you get to pay it off. And how does this work in your favor? Well, over history, I went all the way back to 1950 up to 2024, and everything that's in green was an increase in the value of your property. So pretty consistently from 1950 all the way to 1974, the value of your property went up. Some years more than others. 1950, it went up 3.6%. 53, it went up 11.6%. So year after year, the value of your home is increasing. You're paying off this debt. You have to live someplace, right? Are you going to pay rent or are you going to buy a house? Well, your home that you're buying is an investment. And if it's going to increase in value consistently over time, and look at this, between 1976 and 1999, we had every year was green except for 2 years, 1990 and 1991, where the fair market value of properties nationally, on average, went down 0.7%, and then a 91.2%. So here we have a 50-year period where property values did nothing but go up. The mortgage didn't go up. Rents were going up on average about 3%. So you're paying off your house. This asset that you're paying for is increasing in value. And it becomes, because of inflation, it's becoming easier and easier to make that payment every month. So to service your debt, it becomes easier over time. Again, between 2000 and 2024, every single year we had an increase in fair market value of that property, except for a 5-year period here between 2007 and 2011. And that was as a result of a lot of shenanigans that were going on in the financial industry, but we've recovered from that. So if you had bought, like I did, in 2005, at the peak of the market pretty much, I went through the pain of a 5-year period where the fair market value of my property was underwater. People all around me were foreclosing on their homes, selling their homes, doing whatever. And they actually realized those losses. But if they had hung in there another couple of years, they wouldn't have been underwater anymore. And right now, my property value is easily 50% more than what I bought it for. So is it a good time to buy? Is it a good time to sell? Even in my real-time example, and this is no shit, I bought in 2005 at the peak of the market. I went through this period of all these down years. I'm still ahead of the game. So this is the same data, just kind of plotted out differently, only though from 1990 up to 2025. Historically, what this is saying is about, you can expect to get about a 4% return on the fair market value of your home year over year. And that's what this trend line is plotting out. So going all the way back to 1990, when the average home price was 96,000 nationally, that's what the average price of a home was. And then 4% return year over year after year. And then here it shows the big run up in prices back during 2000 to 2007, where homes, if you look at the trend line, that number relative to the trend line at 222,000 was 21% above where we would have anticipated the value of the homes to be. So we considered them to be overvalued at that point. Then we had the financial crash, and home values were under the trend line for about a 10-year period. And during that period, a lot of things happened, but new construction slowed down, and we'll talk about that in a bit. But eventually we recovered, and here we are in 2025, and we're, what you could say based on the trend of a 4% return on that investment, you would say that we're overvalued, but there are other things that always contribute to the value of homes. So, and we'll talk about these things too, but just know that we have inventory, again, supply and demand. So right now we have a very low supply, and the prices reflect that. So the advantages of buying a home, and although, and this is what we already talked about, although your payment stays the same, what happens to the value of the, is that the value of your home increases over time. The average home increases at about 4% a year. We just talked about this. So if you bought a $300,000 home today, based on a 4% return, I'll send these slides out if anybody wants it. Send me an email. So I have your email address. I'll send the slides along so you, you'll have them. But a $300,000 home bought today on a 4% return would be worth about $400,000 in 7 years. So that's a $100,000 return on your investment in a 7-year period. If it's your primary residence and you have to pay money to either rent a place or buy a place, that's pretty reliable that you're going to make about 100% in value over that period. So what's happening? You're accumulating wealth. Again, you have to live somewhere. You're either paying rent or you're buying a house. In my opinion, the easy answer is you buy. And if it's an income producing property, so this is a second home that you're buying and you're renting it out, that other person is covering the cost of maintaining that home. They're covering the cost of servicing your debt, and you're reaping the benefit of the return on your investment. Property values increasing year over year. So what can we say to buyers? How do we convey this? One thing I want to point out is what I highlighted down here, is that as far as household wealth, homeowners have a median net worth of $415,000 right now, compared with renters that have $10,000. And a lot of what factors into that is the value of their residence. So if you want to accumulate wealth, the easiest way to do it is to buy a home. So you're going to be asked this one, right? How's the market? How's the market, Barb? Yeah, well, here's the answer, right? If I was a little bit better at PowerPoint, I would have been able to pop that one up after. But it's great. Why do you ask? we want to ask that question so that we can find out a little bit more about what is driving their question, what their motivations are, and so forth. But let's talk about inventory of homes, right? So this is national, and I don't want to spend too much time on national numbers. We'll dig into our local numbers here in a little bit. But inventory, as we talked about, is going to drive prices, right? Whatever the value of a home is. So back in the early 80s, when interest rates were above 10%, we had a lot of inventory. A lot of homes weren't being sold, and homes were sitting on the market for a while. Homes were sitting on the market 10, almost 11 months. Then in the early 2000s, homes were selling pretty quickly. They're selling at about the rate they are today, 4 months. We went through a period where, again, we go back to the financial period where we had the financial crisis. Homes started sitting on the market again, and it's all reflected in the inventory, right? We had a lot of foreclosures. We had a lot of homes that were built. There was a lot of overbuilding that went on. All these things contributed to the amount of inventory. It didn't keep up with the demand. At that time, like 2010, 2011, new construction came to pretty much a halt, and the supply that was on the market started to get absorbed, and a lot of those homes got sucked up in 2011, 12, 13. And we have been, this blue dotted line is like the historical average of where you would expect. Oh no, excuse me, this is more of a balanced market. So if we were in a balanced market, that dotted line is 6 months. So we have been in a very strong seller's market for the last 12 years. It felt much stronger after we got done with the COVID lockdown period, because it was like the gold rush and everybody wanted to buy a home, like 2020, 2021. But so we're getting closer to a balanced market, or we're still in a seller's market. New home starts. This is what Marty brought up earlier. So this is historical demand of 1 million homes, although that says 1,000, it's based on thousands. So we have 1 million homes that are normally built every year, and that's the demand. Back prior to the financial crisis, when we talked about a lot of homes being built and it added to the big inventory of homes that we had out there, we had an oversupply based on the demand. But when the money supply tightened up, a lot of new construction came to a halt. And over this 10-year period, we started to accumulate a housing deficit, and we were about over 4 million homes short of what historical demand was. In fact, this year here in 2021, we built nationally 1,127,000 homes. We would have had to continue to build to make up for that deficit of 4 million homes. We would have had to continue to build at that rate for 18 years to make up for that deficit. And we haven't done that. We're just keeping up with the current demand, but not the backlog. So we still have a housing shortage. So if anybody asks you, if my home is overvalued now, or they're feeling like homes are overvalued, the prices are going to be sustained at this level because the buyers still don't have choices. The supply is still not keeping up with the demand. There's still less homes available than there are buyers. That makes sense. So there's all kinds of indicators that we can key in on. Some of them are national, some of them, the ones that are most meaningful to us, are local, right? But we want to keep our eye on national things. So national, which is macro, and we could, in this example, say that here in county, that's micro. If we're looking at the county numbers and only things that are going on in Pennsylvania, we could say maybe Monroe is more of a macro level, and we're looking at, Penn Estates as a micro. That's the micro market. We're looking specifically at that tiny market. But as far as national, certain things you want to pay attention to, obviously, are interest rates, inflation, and GDP growth. So inflation, we could talk about any one of these topics for a day. So I'm moving pretty quickly through these things, but I want to introduce you to the concepts. I'm going to tell you how to find them, how to monitor them, how to interpret them. So these first slides I want to go through kind of quickly. Why do interest rates change? Jim, why do interest rates change? Black magic, they just kind of go up and down on their own? Okay, all right. Ed. They do. They change for a lot of reasons. A lot of things are going to impact that. Go on.
Fed change one.
Yep. So let's stop there. When we talk about the Fed changing interest rates, what exactly are they talking about? Is that them changing the mortgage rates? No. Good. We're all in agreement there. We all understand that. Okay. So what they're doing is they're changing the overnight lending rate. Every night at the close of business or midnight or whatever it is, a bank has to have a certain amount of money in reserve based on the amount of money that they have in the way of deposits. If they don't have that money on hand in reserve, they have to borrow it from somewhere, and they go one of two places. They either go to the Federal Reserve or they go to another banking institution. And that rate that the Federal Reserve controls is the rate at which those two entities will charge the borrower. So if the Federal Reserve drops the overnight lending rate to 3%, that's what they will get charged for borrowing those funds back for however long they have it. 5 days, 30 days, whatever the terms are. Interest rates change based on every market. It's the same damn thing. It's all supply and demand. So if we have a lot of demand for credit, if money's cheap and say interest rates, let's use extreme examples. Let's say interest rates were 0. You could take out a 30-year mortgage and be charged 0%. It's like, here's free money, go buy yourself a house. There aren't many people that wouldn't do that, right? Conversely, interest rates are 20%. It's expensive. Not many people are going to want to do that. There might not be a lot of demand for credit. So the interest rates are controlled. The overnight lending rate is controlled by the Fed. That rate has an influence on the general market, general bond market, and so forth. However, so I don't want to say that it doesn't have an impact on mortgage rates, but it does influence them. But like most markets, it's all driven by supply and demand. If nobody's taking out money, interest rates are 20%, nobody's taking out a mortgage, banks aren't making money because they're not lending anything. So the market itself is and it's free and open market, interest rates will come down. Inflation is going to have an impact on interest rates as well. This is what the Federal Reserve does by changing the overnight interest rates it's going to have an impact on inflation because by charging a higher interest, they're going to start to shrink the monetary supply and by making borrowing more expensive. That concept makes sense, Marika? Did I explain it? Okay. By lowering interest rates, you start to stimulate the economy because borrowing is cheaper. Oh, I can borrow money. I can buy this tractor for my farm. Now I got better equipment. It'll make my productivity better and hopefully stimulate the economy through growth, and it's controlled by lending activities. If we want to slow down the economy, we'll raise interest rates. So right now we're in a period where you hear a lot of talk about interest rates. For the longest time, they've been very low. And they feel high because they had been so low for so long. But we'll get a little deeper into interest rates in a bit. We pretty much talked about that. All right, so here's, I believe this is interest rates. Yeah. All right, look at this chart. If you don't know what we're looking at, this is from, say, 1970 up to 2025. In here, hang on, we'll get to that. I have that graphic. Yeah, right. So, yes, you're absolutely right. That's exactly what you're looking at here. In 1970, 71, whatever that is, interest rates were 7.5%. And people feel that right now, because they're 6.5, oh, they're too high. I got to wait for them to come down. Chances are we're never, ever going to get to this point in time again if we still have a dollar that's worth anything. Exactly. So prior to, or during this period in the 70s, we had inflation at an extraordinary rate. It was a very painful time. I wasn't old enough to have to pay bills then, but I was old enough to realize the pain that went along with not having the money to get anything. It was a very, very challenging time economically for most people. And the way that the government fought inflation was by raising interest rates. So between 1971 and whatever this is, 1983, we'll say, interest rates peaked at over 18%. So if you wanted to get a home mortgage back in 1983, you were going to pay 18%. In fact, in between, what is this, 1978 and say 1989, interest rates never got down below 10%. They finally got inflation under control, and then we went on this slide and this borrowing spree and this money printing spree where the government just couldn't spend enough money, they couldn't print enough money, and now we have inflation again. So these were the good old years. This is gone. What we're going to see is up and to the right again. That's something I wanted to point out. So although interest rates are on the rise, or if they're going down, it's never in a straight line, although we had a pretty straight line there. They're going to deviate. Like if we were to zoom in on this, you would see that, you know, overnight it's going up and down, but it's never just in a straight line. Again, in October of 81, interest rates for 30-year mortgages peaked at 18.6%. Well, let's read through this. This is exactly what you were asking about. In April of 1971, the interest rate on a 30-year mortgage was 7.3%. And if someone was waiting for interest rates to drop just 1%, they would have had to wait until August of 2002 for interest rates to come down just 1%. That's 31 years. And between 1978 and 1976, they were never down below 10%. Now let's talk about the cost of waiting on that. So if you had bought a home in 1971, although your interest rate was 7.3% or whatever, the average home at that time would have cost you $28,300. That was what the median home price was in 1971. By 31 years later, the median home price in the United States was $201,000. Today, that same home is worth $360,000. So if you had bit the bullet in 1971, when you thought that interest rates were too high because they were 7.3%, you didn't know that for the next whatever many years, it was never going to get that low again. Another 30 years, it wasn't ever going to get there. But if you had waited, you waited, well, eventually you would have been able to buy that house, but it would have cost you $360,000. Now, part of the equation is income, employment. Wages need to keep up with inflation, otherwise our standard of living drops, which it does. But just to keep things relative, back in 1971, the median income in the United States was $10,000 a year. Yeah, yeah, I was a little kid. Yeah. So wages do rise, things stay relative, but what you're doing is that investment is, number one, the investment of buying a house is increasing with value. It's maintaining your purchasing power, so those dollars are still, you're not losing value. In other words, when I talk about purchasing power, if you were to take $1 back in 1971 and put it in your mattress, you didn't invest in anything, but you saved it, right? Inflation went up year over year over the last 50 years. That dollar is going to buy you what? Can't even buy a loaf of bread, right, for $1. I don't know what you can buy for $1 anymore. Right, but back then,
One of the things that this doesn't take into account is how families lived in 1971 compared to now.
Well,
She said, what Marika said about the income difference doesn't seem that great for like the prices of
Right.
things. The average household back in 1971, I'm sure, had 6 people.
yeah, well,
One cell phone each.
yeah, the one cell phone that hung on the wall and had a cord hanging to it. So here, what I'm trying to do here is to try and put it in perspective. So in 1971, a 30-year mortgage on $28,300 with 20% down and a 7.3% interest rate, your principal and interest payment would have been $155, which is 18% of your monthly income. And your median expendable income was $850 based on, the median income of 10,000 or whatever it was. If you had bought the home then and you were paying your mortgage over the course of the next time, so yeah, the value's gone up, you're making more money. Well, at the end of 30 years, where are you? Well, you're making $3,500 a month and you're still making the $155 mortgage payment, and that's now about 4% of your income. That's like you probably couldn't even buy a car and have a car payment of less than that. Yeah, not even a 20-year-old car, right? So the cost of servicing your debt becomes easier and easier. Inflation works in your favor over time to service the debt that you have. The lock-in effect. Okay. Anybody ever heard of this term, the lock-in effect? All right, well, it has to do with folks that have bought their home 5 years ago, whenever, and interest rates were really low. Say they took out a mortgage and the interest rate that they were paying on the mortgage was 2%. You know, plenty of those people. Well, they're a little reluctant to sell because if they sell, they have this affordable mortgage right now. They might get a shit ton for their house when they sell it, but then to buy something that's comparable, even if they're downsizing, it might be less affordable for them because the value of those homes, a smaller home at a higher interest rate might not be cost effective. They might just assume to stay put, so they're locked in. This has contributed to the lack of inventory. We talk about the lack of inventory because of new home starts that we didn't have, new construction. That's another contributor to the low inventory. Another factor that I'd like to mention, it's not on my chart, but another thing that had happened that I don't think had ever happened throughout history was a lot of investors had entered into the residential home buying market during the last 5 to 10 years at a rate that they never had. So we had a lot of investors that might have looked to buy a home, mom and pop, second home, they're gonna rent it, maybe it's their vacation home, they're also gonna rent it when they're not staying there, or now short-term rentals are a big thing. But large investment firms at an unprecedented rate had gotten into the home buying market. And they got in when home prices were depressed back in 10 years ago, and it was a good investment. Suppose you're an investment banker. I was talking to Marek about this yesterday. Suppose you're an investment banker and it's your job to make money for your investors. And you're looking at the stock market, and the stock market seems like it's overvalued. And you're assessing every market out there, and you're trying to figure out where I can get the biggest returns for my money. Somebody started the first domino, and one of these banks decided we're going to get into the housing market. And they started snatching up single family residences. And they did so at a rate, and I think they're still doing it, about 1 out of every 5 homes nationally is being sold to an institutional investor and turned into a rental. So we have all this competition. Families want to buy a single family residence, and they're competing against investment banks that are buying the homes, fixing them up, putting them on the market for a rental, and those things will never come back on the market for sale. Not for a good long time, until that's not a profitable business for them anymore and they decide to get out of it. So those things, probably more than anything, have contributed to the housing shortage. You have a question? Shaking your head. Oh, okay. Oh, wait, did I glaze over that? So this is something to just, I don't want to glaze over. It's a fun fact, right? When we talk about the lock-in effect, out of all the outstanding mortgages that are out there right now, 92% of all the mortgages have an interest rate of 6% or less. 82 are paying 5% interest. And 1 out of every 4 homes has an interest rate of 3% or less. That's remarkable. Yeah. Probably not thinking of selling, are you? 2.45. Yeah, never sell that thing. Hang on to it forever. Exactly. Yeah.
It's still a lot, though, isn't it, though?
Yeah, 1 out of every 4.
Yeah, when we look at 4%, right? 62%.
Yeah. That's like, yes.
Is 62%.
When does the big place?
What time is it? Am I going overtime? Yeah. All right, let me blow through some of this stuff. There's a lot of good stuff here, folks.
Yeah.
But I did. But what I really want to do is I wanted to like get your interest. I wanted to pique your interest, understand how some of these things impact us. And now let's just briefly talk about where you can find it, where you can look at some of this stuff for yourself. And specifically, right, there's a lot of stuff. There really is.
I didn't know.
Yeah, I think they were trying to, they gave me the soft hook there. Yeah, absolutely, absolutely. In fact, if there's anything that I went over that anybody has questions about, I did go over it quickly. You can ask me, come find me. We can talk about it. Obviously, I can talk for a while about some of this stuff. Some things that you want to keep an eye on. If you think, okay, the market's going to change. What can you look at to see that the market is changing? Well, if inventory starts to go up, right? If another thing would be mortgage delinquencies. You can one of the websites on the page handout that I gave you was the FRED, which is the Federal Reserve of St. Louis. They monitor mortgage delinquencies, and you can keep an eye on them too. Right now, although times are tough, it's not being reflected in mortgage delinquencies. And when it does start to show up, you can see, well, you can draw your own conclusions, right, about what drives mortgage delinquencies. What drives that? Unemployment, right? So I think that that's a key indicator right now is you want to keep your eye on unemployment, because that will then forecast somebody doesn't have a job, or the majority of people don't have jobs, they're not going to be able to pay their credit cards. They're not going to be able to pay for their mortgage and whatever other debts they have. So keep an eye on auto loans. Typically, I would think that if somebody lost their job and they're faced with their electric bill, their food bill, and their car payment, what's the first one they're not going to pay? Yeah, right. So keep an eye on those things. Those are good leading indicators of what might be coming down the road. And when you look at them, you can also see, okay, the number of loans that people are delinquent on, but you can also see, are they 30 days late? Are they 60 days late? Is that trending up? Are they 90 days late? Once they get to 90 days late, they either repossess or foreclose or whatever. So you can keep track of foreclosures, but this is a leading indicator of foreclosures. Monetary supply. Geez, guys, I got to blow through this too. Bob's got a class to start here. All right, the last couple of slides, and Bob, I'm wrapping this up.
No problem.
Our market here in Monroe County, I want everybody to realize that when you log on to Flex, the first screen that you log into has like a bunch of symbols, and you probably click on, Flex data or whatever. There's like a link to CRS there. There's a link to Facebook. I don't know why we have that, but there's a lot of different links. But if you scroll down, one of them is called Market Stats. Click on that and get comfortable with it. You're going to see a lot of these kind of, you can probe into our local market and see all kinds of data. You can see average sales price. You can see days on market. You can track all kinds of data there. This here, I just put up average sales price from whatever period this was, probably a 3-year period, like 22 to today. And you can see that here in our local market, the average sales price has gone from about 270,000 up to where it is today, about 355,000. 3 years. You can keep track of number of homes on the market, and that'll give you your supply, right? So when we talked earlier about supply being seasonal, you can see that very clearly in this chart. You see that in the summer months, we get a lot more homes for sale. In the wintertime, a lot of people take their homes off the market, and it happens year after year after year, and it's very repeatable.
people think homes don't sell when it's cold.
Right. You can look at, again, just go there, poke around. There's a lot of data. You can see, so that was supply, here's demand. Closed sales, number of homes sold. And you can see that here for like the last, pretty much the last 2 years, we have a pretty consistent average of about 200 homes a month selling. Sometimes it's more, sometimes it's less, but on average, I think we're about 200 homes a month. And that's our current demand. And it's, you know, pretty, I think last home we had 205 homes that sold. All right, we'll wrap it up there. We're done. Any questions? If you have any questions, come and find me. We can talk, email me. I'll send you a link to all the charts. And then if you have questions, come and find me. Thank you. Thank you. You're welcome. Thank you. Thank you.
Running over here from the thrift store. I called the door again.
Thank you. Are you